So absolutely delighted to have Stephen Kiel here with us today. He's the founder and chief investment officer for Kitos Capital Management. He's also the portfolio manager for Kitos Capital, a value-oriented private investment fund. He's also the executive chairman of Enterprise Diversified, an alternative asset manager. Prior to launching Kitos Capital in 2012, he was an attorney in private practice. He was also a member of the Army Reserves, a veteran of Operation Iraqi Freedom, and retired with the rank of major. He brings an unconventional perspective to the management of the portfolio, combining traditional analysis with the mindset of an entrepreneur. Thank you for joining us today, Stephen.
Yeah, great. It's great to be here. Thanks for inviting me.
Yeah, absolutely. It's a pleasure. So yeah, great. Let's just begin by you talking a little bit about your philosophy and your background.
Yeah, I mean, I think what I'd like to focus on a little bit more here is less, and we'll get into some of the Q&A, but less of the investment things themselves, because I know you're hearing from a lot of value-oriented investors, and we all sort of have the same philosophy, same inspiration, things like that. I'm sure there's a lot of overlap. It's not very popular to call, to say, well, Buffett, is an idiot or something like that. Almost all of us were inspired at some point to learn about the industry from, if you're a value investor, from Buffett and Munger and Graham and people like that. So, but for me, what I'd like to maybe begin with is my personal journey to become a fund manager and to become involved in a small public company, because that wasn't what I set out to do when I was like in high school or college. I was really more involved in politics and public policy. And when I was in high school, I was very much interested in government, and I enjoyed business-oriented things, but I grew up relatively poor, and so I didn't have access to investing. I didn't have any sort of education from parents, from family members, or any sort of mentors about the stock market. I didn't know anything about it. What I do remember is being kind of 11, 12, 13 years old, and I would, I'm in my early 40s, so we had an actual newspaper, and I would go in the Sunday newspaper and I would look at all the ticker symbols, and I would look at the prices, and then I would kind of compare them week to week for no reason. I had no idea what it meant, other than it was kind of interesting to see the changes. And then at some point, there would be news in the business section, and I'd say, well, I wonder what will happen, to this next week's ticker symbol. So it's kind of like interested in a curiosity, just because I was interested in numbers and I was a little bit analytical, but I really had no idea what it meant. But I did have a nice, I think, business type of background. I mean, I had paper routes, so I actually delivered those newspapers back in the day, which I don't know if they do that anymore either. And I saved up money. I had a kind of a compound interest style mentality, even at a young age. And so when I went to college, which ironically enough, I got into Brown, I didn't go to, I should have. And I was a track and cross country runner. I played basketball in high school as kind of an athlete, and I got a scholarship to run in college at a small private school in Illinois. So I went there, and I ended up transferring out after a year or so. And I studied political science, and I worked for campaigns, and I decided I was going to go to law school. And I took business classes, certainly, and I enjoyed them, but the classes that I remember really were not practical in any way. Everything was theoretical, and there was nothing about investing specifically. But at the time, I enjoyed reading biographies, being involved in kind of history and government and politics. I loved reading biographies of these important figures in history. And so, of course, I found out about Warren Buffett. I read a biography from 1996 called The Making of an American Capitalist by Roger Lowenstein, which is an excellent book. And Snowball is as well, the biography of him. But the Lowenstein book, I think, is very valuable to read. And it really is focused on business building and less on stocks themselves. And I think that's very important, especially early on when you get into the industry, or if you're interested in just investing on your own, is to look at these types of things as the business themselves and not the price. You know, if you look at the price, you get kind of anchored on that, and then you work your way back to determine if it's a good business or not, right? And that's not the way, that's the way a lot of people look at it today. That's not what I think. I don't think that's an effective way to do it. It's better to learn about businesses and industries and look at the stock price later on, right? So, you know, I was kind of interested in doing that. I invested a little bit, but not a lot. I mean, I didn't have any money. And then I joined the military I wanted to take a year off between undergrad and law school. And so I joined the Army Reserves, and I did some training at Fort Benning in Georgia, and other things like that for about 9 months. And then moved to Washington, D.C. I went to law school at George Mason School of Law. And George Mason, the law school was unique because it was very focused on kind of Hayek-like economics. So it had a law and economics center. It looked at the legal world from an economic perspective. And so that kind of exposed me even further to certain economic theories and things like that, which I think was interesting and informative when I got into investing kind of more full time. And you know, kind of informed the respect for capitalism and everything that's, you know, kind of makes our country is what it is today. And so, you know, I ended up going to law school at night. I worked for a public policy organization during the day for years, for 6-7 years. And I thought I would kind of run for office or something one day or something like that. But living in DC, I got burnt out from just the partisanship of everything. And, you know, I think and this applies to investing in a good quality, I think you should have to be successful, is you really have to be open-minded. And you have to consider each argument as if it might be true, and then attempt to debunk it in your head or, you know, even amongst others. But you have to consider the other argument. And, you know, politics is really more kind of taking a position and then defending it. And that's a difficult thing for investing because you want to be able to be flexible, to have the opportunity to change your mind. You know, and Charlie Munger said this, that you really want to take the other position, take the other side, and to be able to argue it just as well as the person who has that position, and because that then gives you the opportunity to debunk it, potentially, or maybe it'll change your mind. And that's difficult to do in politics. I think it really does kind of screw up your mind, especially living in DC for so long, where you're constantly defending your position, and it starts to kind of really helps you over time. You start to not consider the opposite as much because you're always defending yourself. And so I started recognizing that like intellectual honesty is not valued in politics, as you'd imagine. And so I practiced for a few years after I got my law degree. I had a deployment to Iraq, came back, practiced for a few years, did not particularly enjoy it. But again, that time ended up being kind of informative for the investing side, because I learned a lot about kind of the inner workings of the SEC and just different mergers, different regulatory agencies and things like that, and the decision making they do. And I'd been investing kind of personally for some time then, and I started seeing all of these kind of arbitrage opportunities, right? So some of it is regulatory arbitrage, some of it is just seeing even the inner workings of these public companies. I mean, a few cases where I was, you know, kind of seeing everything behind the scenes of a few large public companies. And, you know, when you're looking at some of the documentation, you realize like this CFO is an idiot. I mean, this guy is dumb. How did he get to this role? How did he get to this position? He doesn't know what he's doing. And some of the decision making, the capital allocation decision making specifically, that never comes out in the public, but it's discussed at the board level or discussed at the senior management level. You're like, these guys don't know what they're doing at all. It was very enlightening, because I had always assumed that there was like certain minimum level of competence, to get to that position. But it's not always like that. Sometimes the idiots kind of rise to the top, or the people who are best at backslapping or best at inner office politics. Sometimes they kind of rise to the top. So it really gave me a great respect, honestly, for Carl Icahn. I don't know how much, Carl Icahn isn't really a value investor, but he's really worth following because he recognizes more than anything else the idiocracy at a lot of these companies. And that's what made him an activist investor, and he's had some successes through that. Without a lot of, I'll say for him, what appears to be not a ton of specific research, because honestly, when you're dealing with a situation like that, trying to figure out something to the decimal point is not really worth it. If there's generalities, you can say, well, if these certain things change, if these capital allocation strategies change, or if you get someone who knows what they're doing making these decisions, then all predictions go completely out the window. You'd be surprised at how amazing a company can turn around when there's a strong decision maker on the top, an experienced capital allocator. So at any rate, I practiced law for a few years, and then in 2009, I started kind of managing a few accounts from friends and family. And then in 2012, I started the fund, Kitos Capital, that I've been running for the last 10 years or so. And in 2015, we took over a small public company. At that time, it was called SiteStar. Now it's called Enterprise Diversified. And we had some internet. I mean, if you want to talk about, this is a public company that traded on the SEC. It was SEC regulated, SEC filing, and publicly traded. It was at times like a $5 million company. Now we're 20, 30 million in any given day. Still very small, but they had a dial-up internet business. So we had a dial-up internet business in 2015. Really great business. And it's kind of interesting. It has some real estate as well, and it traded for less than its net assets. Traded significantly less than its net assets, which is why I got interested in it. But the dial-up internet business is kind of ironic to think, well, this is a dying business. Well, certainly it's dying, but there's predictability as to how much it was dying, and there was not good decision making, in terms of maximizing cash flow from that. So when we came in, we did that. Now we know what the decline rate is, pretty predictable, but it throws off a ton of cash, and the margins are very high. And this kind of goes to the Ben Graham idea that, or even like Schloss and others like that, that there's one or more puffs left in the cigar here, or in the vape today. I don't know, the last puff of the vape. And yeah, it's kind of interesting, right? So you're like, yeah, you can maximize these things, traded ridiculously low multiples, but you can maximize the cash flow, and you can use that cash flow to either reallocate elsewhere or to buy back shares or to give dividends or whatever the case may be. But if you run the business to say, well, let's not take that excess cash flow and reinvest in this dying business, let's take it and reallocate it to a higher and better use, which on a huge scale, that's what Berkshire is, obviously. We did it on a very, very tiny scale, and obviously not very successfully relative to Berkshire or something like that. But it was kind of interesting to see the inner workings. And then, we brought some people on board. We actually started an outsourced then operational business where we handle Enterprise Diversified, and through its subsidiary Willow Oak Asset Management does operational support for some private funds. We made a seed investment in a fund and things like that. So that's what the business is today. But to see the inner workings and the discussions we had at the board level, and the really specific, intricate accounting things being on the inside, really humbled me as to how much you just don't know, as an outside investor. And that no matter how much scuttlebutt you do, no matter how much research you do, you'll never know specifically what's going on unless you're on the inside. And that doesn't mean don't do the research. Obviously, that's very important. You want to be able to analyze the financial statements and things of that nature. But what it made me very humble about is you have to really look at the incentives in place, and you have to look at the quality of management. You have to look at that experience, their capital allocation experience, their decision making related to that. And if you come across companies like that, and there are some that are just beautiful companies, even some that they're just such great companies that even if management is poor, they're still great, oligopolies or monopolies, things like that. These are the best investments. But if you look at these types of talented managers, they're going to surprise on the upside over and over and over again. And if you're really looking to get that 15 to 20% return over time, which would be an unbelievable return, you really have to hitch your wagon, especially if you get larger as an investor. You got to hitch your wagon to those great management teams. But until you get so large, you have some arbitrage opportunities. You can take that last puff out of the cigar. But at some point, you transition every value investor, or let's replace the word value with fundamental bottom-up investor. Everyone at some point transitions into that quality business with quality management. And it's because at some point you're like, it's just not worth the time to continue to roll over arbitrage investments or to continue to have to pay taxes, when you get into the higher tax bracket and things like that. And sometimes for years you don't find tremendous opportunities. And it's a heck of a lot easier to identify at some point, identify these great management teams and great companies and then monitor them and, try to find a decent entry point, right? So that's also value investing. It's also fundamental bottom-up investing, but it's not the kind of traditional Ben Graham style. That's probably, what Buffett has transitioned into because of his size. So yeah, with that being said, I do a little mix of both at this point through our Kitos Capital. We still control a small public company. It's been an interesting ride to do that. And, I'd say for me, transitioning away from the legal work, which I did not particularly enjoy doing, but I learned a lot from, and having the law degree was a great foundation, especially when a lot of your competition, comes up with an MBA or they come up as a formal analyst on Wall Street. Sometimes sell side, sometimes buy side. It's fine. Like, this is fine to do. It's great. But how do you differentiate yourself? Not in the eye of an employer, but how do you differentiate yourself in the way that you think? And for me, my, different experience coming up on the legal side, looking for arbitrage opportunities, really enjoying, I enjoy, and this is something about law school for anyone, who's listening, who's interested in going, or is in it. You realize to read through some of the S1s or S4s or other regulatory filings, it's kind of enjoyable. I don't think most MBA students or MBA grads really enjoy kind of going through an employment agreement, which is filed oftentimes, or an S4. And I kind of enjoy it, honestly. And I think that's from the legal background. And I think that does give a little bit of an advantage, because there's things you find in an employment agreement that you can get an advantage from, right? Because you might see a change in incentives, or how is the board incentivizing not just the CEO, but the CFO or the COO also. And you can see that in the employment agreement, and you can compare it year over year. And sometimes going through some of these kind of long documents, whether they're merger agreements or whether it's whatever the case may be that's being filed, long 8K or something, it's worth taking a quick look at and seeing if there's anything unusual. And, if you find one or two really unusual things a year, you'll find them kind of more often than that, but one that actually turns into an investment opportunity. If you find one or two of those over a year or two, you could have a really significant return just from that one position. And, things even going into the bankruptcy docket. I have a friend, Thomas Brazil from 507 Capital, who does distressed debt investing. And he and I have found some really tremendous opportunities over time, mostly from him through the bankruptcy side. And, going through documents that are public, but maybe they're behind a paywall or something like that, or filed with a court. I had a great investment. We can get into maybe specifics. Great, say 2014, was a company called Arctic Glacier that went through a bankruptcy process, and it's a legitimate company. There was a duopoly in the ice company world, exciting, of North America. It was Ready Ice and Arctic Glacier, and they were going to merge, and the FTC blocked the merger. And then a few years later, Arctic Glacier went bankrupt. And so during that bankruptcy process, you could read all of the files. And if you read the files in the bankruptcy court, you would see those who were bidding, how much potentially they were bidding for the assets of Arctic Glacier, and who the potential bidders were. Obviously, Ready Ice was one potential bidder, but then there were private equity firms, other things like that. And then you'd realize that these bids were likely to be significantly higher than the debt, which means there's a little bit of value left over for the equity. And, the equity, so I don't even remember the $1 million amount, but I remember the stock was like 4 cents or something like that. It's crazy. I think it ended up going off at like 24 cents, right? So you can make 5-6 times your money, even less if you find it later on. And all this information was in the files in the bankruptcy court, and stuff like that is exciting. There was even volume. You could have bought quite a bit. I think I did buy quite a bit. I had a great year because of Arctic Glacier back in 2013-14. And so, stuff like that is fun and interesting. It's kind of finding a needle in a haystack, and the legal background helps there. I think, if you came up as an analyst working on kind of large companies, you decided to start a fund, you're not going to be more excited about going through bankruptcy docket at a 4-cent company. But you got to find your niche anyway. So that's my niche. I enjoy doing that. It kind of gives me a little dopamine rush or something like that to see something or find something that others don't know yet or haven't found yet. So anyway, this kind of brings us to today, and the takeaway for me, at least, and what I would put out to you as potential career move, or what you're looking for to do in your career, is find something that you really enjoy doing. Get a lot of diversity early in your career. I think having the legal background, having the background experience in Washington, D.C., then starting the fund, having the internal management experience has really been enriching to me. It's been very helpful as I look at things, potential investments. And when you're young, when you're just out of school, you can get that wide range of experience, and it's something you may not be able to do later in life, just because you have the flexibility when you're younger. And so I would highly recommend trying to get that diversity of experience, and then when you figure out something you like, really get into that. And whether it's, if you're an investor, whether it's a specific industry or a specific type of investing or specific geographical area or something like that, find what you like, find what you have the experience in, or maybe where you have some sort of an advantage, and run with it. So from there, happy to kind of answer any questions and go into more detail if you'd like.
Yeah, absolutely. Thank you so much. That was really excellent. And there are, very unique things that you discussed there. So let's start maybe by talking a little bit about, some of the things that you're doing that I think are kind of similar to, what maybe Buffett did in the 60s. And so one of those is, what happened with Enterprise Diversified. I'm sure there's probably other sort of, small companies that maybe trade for, a few tens of millions, and maybe, are trading to a discount to net current asset value or to NAV or things like that. Are you sort of tempted to, I guess, maybe partner with other funds, or maybe just use your own fund and buy up a substantial amount of the company, and maybe even do some sort of, hostile takeover where you sort of like force the company to, to either sell the real estate or something to realize that catalyst for value? I know that's something that Buffett did a lot in the 1960s, but I would imagine a lot of, the regulation and the laws and the legal sort of component has changed since then. So how appealing does that seem to you today?
Yeah, it's it's difficult today given the regulatory environment. And if you remember back in the Berkshire, if you remember, nobody remembers, thankfully, not old enough to remember, but Buffett made a comment a few years ago. He said the worst investment he ever made was Berkshire. And the reason for that is because he had other businesses that he ended up putting into Berkshire. And if he would have just done the other businesses themselves, particularly National Indemnity Insurance, they would have just brought it public himself without going through Berkshire. It would have been worth multiples of what it ended up being in the beginning. And not only that, but Berkshire was a drag. It was a declining business. And he continued to make reinvestments in it for some time, even though those reinvestments were those returns were significantly below his opportunity cost. And so, I'd say for me, there's a lot of brain damage that was done for enterprise diversified sites from the beginning. It's fine now, but it was a lot of work in the beginning. Something I wouldn't necessarily want others to do. And obviously, as I mentioned, I learned a lot. And that's valuable. And I think you want to seek ways to try to learn kind of how it is on the inside, so to speak. I've had several friends who've also taken over small public companies to varying degrees of success. And so it's not easy. I probably would not recommend it. We were a little more idealistic. We had the same idea, I don't know, 6, 8, 10 years ago, with a band of kind of other small fund managers. And we did it on several occasions. And, sometimes it's been successful, sometimes it hasn't been. It's too soon for any of us to see a kind of, massive success because it takes years and years of compounding. But I'd say there's a different skill set from management and investing. And there's different interests as well. I mean, I think to be a very successful investor, if you're managing your own money or you're running a fund or something like that, you really need freedom of time, the ability to not have someone looking over your shoulders all the time, questioning a decision. You have to let it play out, right or wrong, and then learn from it. And when you're an insider where you're actually involved on the management side, your day is filled with meetings. Your day is filled with kind of tough decisions, a lot of brain damage, as I mentioned. It just where the mindset is, you're dealing with human resources things and interpersonal relationships and everything like that, which is great. But really great investors set emotion aside sometimes. But management is dealing with other people's emotions for the most part and inspiring them and things like that, which is good, and it's a good experience. But it's difficult to both be doing that at the same time as you're being a capital allocator. So I'd say if you find a really unique opportunity where there's a significant mispricing, please let me know. I'd love to look at it. But kind of small cap, micro cap activism is a little bit tougher than I would have anticipated.
Yeah, that makes sense. I guess just speak a bit more about, what are some of the other signs that you looked for before, acquiring the company and trying to push some of that activist change across? I mean, was there anything where you said, okay, management owns like a small enough percentage so we can own more than them with the company? Or like what types of other things did you look for? And how did you really just to be clear, did you sort of out the original management from the company? Or how did that work? Okay, so how did that sort of process work? How were you able to really push them out?
Yeah, it was, we did. We had a number of investors, a couple small fund managers, and then some private investors. And we ended up doing a proxy contest. We got elected to the board. We had a standstill agreement and basically a compromise where we had an equal number of board members from the old company and the new. And then at some point, one of the board members on the side of the previous management kind of came over to our side, let's say through rational thought. And from that, we fired the CEO and he resigned from the board. And so, but that process took about a year. year and a half or so. But I'd say, what characteristics are you looking for? And it was expensive, by the way, not cheap. So that's something to take into consideration as well. Is proportionally, if you're taking over a small public company, proportionally, you're going to incur a number of expenses. And typically what happens at the end is if you win, you get reimbursed for those expenses by the company. But if it's a small company, that might be a significant expense to the company. So you're also losing there. But I'd say for characteristics to look at, even if not an activist position, but just as a company that might be an interesting thing to own, is you want to look for kind of hidden assets. So sometimes it's real estate, where on the balance sheet the historical cost of the real estate is listed, but if this company's been around for a long time, if they've owned the real estate for a long time, maybe you can go out and figure out what today's value is for it, and it might be significantly more than the historical value. You want to, at some point, I was looking for a net operating loss carry forwards when the corporate tax rate was higher, and we found a lot of great opportunities with that. Some nice investments there. That's not quite as big today because of the tax law change. But even so, I mean, today, if it's 20%, the government's getting 20%. If you can save that, I mean, it really increases your net margins. It could be a nice investment, right, for you. And I think at the management level, you want to look for, if you're looking to make a change, there has to be a deficiency there, or a problem, or something that you can change very easily. Not very easily, but it's something that you can change that will significantly change the results because of maybe different capital allocation decisions or something like that. Sometimes there's a toxic kind of workplace environment. And I'd say the last thing I'll mention right now, I think, is sometimes you'll see a particular subsidiary that could just be let go or sold or something because the opportunity cost of reinvesting in that subsidiary is not as high. All right, I'm sorry, the returns on invested capital of that subsidiary is not as high as the opportunity cost. Sometimes that opportunity cost is buying back shares or otherwise kind of distributing money or cash to shareholders. Sometimes it's reinvesting in a higher performing subsidiary. Sometimes it's an acquisition or whatever the case may be. And so that's something to look at. And you can do this with larger companies too. When you think about activists such as Icon or Ackman or others, that's what they're looking for, is the sum of the parts is much greater than what the stock price is right now, what the whole is. And so what can you do to unlock that value? And it's getting rid of a specific division or a subsidiary, or just changing your capital allocation outlook in terms of invested capital in the business itself. And that's, I think, something where you can really passively be involved, whether you're coattailing some of the larger activists or having friendly conversations, with management or something along those lines, or even seeing that they already are going to make those changes or in the process of making those changes, and then kind of investing at that point when the ball's already rolling.
Yeah, absolutely. I think that makes a lot of sense. So your returns have been really excellent, I think, since you've begun. I think they're like 22%, 23%, somewhere around there, I think, a year gross returns. I mean, imagine, so let's say there's students that, are very dedicated and, they really will put in sort of the effort, but they don't have, I guess, a major amount of capital, enough where they can sort of do activist campaigns. And they also don't sort of have the legal background that you have and sort of the understanding of those things. Do you have any advice for them how they can still sort of find some, like maybe any other sort of factors that play into your search for investment ideas, into your evaluation for investment ideas, that you think students would also be able to use?
Yeah, I mean, I think if I was in that position, and I was in the beginning, I would write up ideas that you find. I would, whether you create some sort of blog or you have some idea, some place where you can share it, such as like a Sum Zero or a value investing club or something like that. And you share your ideas. You'll get a lot of respect for doing that. And if you're applying for a job, send a stock idea along. That's always appreciated. I think that's the best way really to catch the eye of entrepreneurial funds, those are the ones you really want to work with, honestly. More fun environment where it's like results oriented. And I think in a lot of those people, myself and other fund managers who are kind of think similarly as me, we don't really care about pedigree as much. What we care about is that, you have some sort of unique angle, not necessarily even with experience, but you've demonstrated in some way because of the, idea that you found or the area of interest. And so demonstrate that, make it public in some way, share it, when you're applying for a job, or just, form kind of network relationships. I think the best thing I ever did was, even 3 or 4 years before I started the fund, kind of a social person. So I just enjoy getting to know people and meeting them and in the field, and some of those people who I met that just started a fund with like $500,000, it's $1 billion fund today, because they were smart. They were just starting the fund, they were networking well. And so I would go out to these events, go out to Berkshire, go out to the Daily Journal meeting was entertaining. I started going there in person. It's been online the last few years, but when it opens up again, you go to the Fairfax meeting, Toronto, go to the Markel meeting. They want to, Berkshire, and then also in Virginia and things like that. Start going to these company meetings too, the annual meetings, once they start going back to in person, if they ever do. And it's kind of interesting to come across other investors in those meetings and talk to them, be social. Like my biggest plus, at this point too, is the network that I have. There's a lot of idea sharing that happens through that, and there's a lot of idea generation there. And there's resources now that really didn't exist in the way they do today. When I started, it didn't exist in the same way when I started, like a Twitter. There's a financial Twitter community, FinTwit community, and other things like that. There's Discord groups, there's Reddit threads, et cetera, et cetera. Just stay away from the BS. But once you find the niche of the things that you're interested in, make sure it's fundamentally based. Get involved in that. And I think that's a great way not only to learn more, but also to potentially get a job, or to share some ideas, or to get good feedback on an investment that you might be making.
Yeah, absolutely. I think that makes a lot of sense. And how useful, a lot of your approach revolves around arbitrage, from my understanding. How useful do you find either quantitative screeners or maybe keyword screeners? For example, do you screen, would things like, let's say, company acquirers and then like net operating losses, does that type of stuff tend to bring useful results for what you're looking for?
Yeah, it's kind of interesting because some people do use screens successfully. I have, on occasion I'll screen, but not very often. And my reasoning more is, a lot of things that screen well, where the stock price is maybe not appropriate to how its fundamentals are, is screen there. I feel like maybe they've already been found, and right or wrong, I don't know if that belief is right or wrong, but it's kind of something that why I don't do a lot of screens, because I feel like, okay, you've got these great return on invested capital, you've got great, whether it's some certain net margins, gross margins, when you've got some sort of, other characteristics, ROEs and formulas and things like that are strong, but the stock price is not. Like, well, okay, well, most of the time the stock price is right. It's not specifically right, but most of the time it's approximately right. And so you got to find the times when it's wrong. You do have to be humble to the wisdom of the masses, so to speak. So not that I haven't found things through some of these screens, but I just have other ways for me to find for doing idea sourcing. Now, that being said, I do some keyword searches, and that's kind of a form of screening. Let's call it a qualitative screen or something like that. And sometimes it was, and not really today as much, but a few years ago, the net operating loss carry forwards. I'll have different keywords for things like contingent value rights. I'll do things like, follow executives' names. I'll follow activist investor names. I have a lot of Google alerts set up. And you can do alerts on SEC filings as well. So, if you're really interested, what I do is I have like an RSS feed, and I have various types of filings, interesting filings in that feed. And then it, just refreshes throughout the day. Every morning, I just kind of scroll through it, right? So I see every S1 and S4 filing every day. I mean, sometimes these are 300, 400, 500-page documents. I'm not reading everything, but I'll scroll through every S1, at least click it on and say, okay, there's something interesting here. Do I recognize anything? Is it worth looking into more or not? And so, typically when I start the day in the morning, I'll spend an hour or two doing that, looking up various 8Ks. And if you do that, you see all these filings, you start to see repeat things. You start to build some pattern recognition. I think the greatest skill, a lot of skills that you need to really be successful over time, but to be really successful, you have to have a mind for pattern recognition. And what that means is taking in a lot of information, discarding most of it, but seeing those scenarios that have worked in the past. And then when you see a tidbit of information today, it seems to allude in some way to that previous success or failure, if you need to avoid something. And it catches your mind to say, yeah, this is something I should look into a little bit more. And that's why I do all the RSS feeds and the news searches and keyword terms and stuff like that. Because, if you've spent a lot of your time for years and years and years reading 10Ks and learning about different companies and industries and situations that have worked out and that have failed, over many years, at some point you'll get to it where you see something that otherwise might seem innocuous, and you'll see it and you'll notice something though, and you don't even know what you notice, but you get a little butterfly in the stomach or something. Investing is not completely rational or analytical, but something in your mind, something or in your senses notices it, and then you set it aside and read more about it later. So you really want to build that knowledge base and foundation, so later on you can have a wider area of pattern recognition.
Yeah, absolutely. I think that makes a lot of sense. And thank you for sharing that framework with us. Any advice for, let's say, students who one day aspire to start a fund, knowing when is the right time to start your own fund, and how do you raise that initial capital?
Yeah, I mean, it depends what your background is. So, if you're coming up with a finance degree, if you're in an MBA or you're in a law degree or something like that, depending on what industry you work in, maybe you did become an analyst, or you're an investment banker, or you work on Wall Street in somewhere, you work in some way finance related, fine. If you work in a different field, you got to bootstrap it a little bit more, but the underlying thing is, no matter where you work or what you're doing, you want to be able to invest on your own. First, keep track of it, be intellectually honest about it, and build yourself a track record. Can start early on. And, if you're good, some of your coworkers will notice and some of your family members will notice. And at some point they might ask you to do invest for them, or they're asking you for advice, things like that. And that's a good indicator that, maybe you're onto something. If you don't work in the industry, I was a lawyer, I wasn't a lawyer in the industry. And so I just kind of bootstrapped it with some friends and family money. And then we're still very small, but we, have a couple institutional investors and things like that. Just kind of bootstrapped it. And you're doing well with your own money, so you're making a little bit as well. You can invest, and you can do it very small. Look, even I talk about myself so much, but David Einhorn started with less than $1 million. Even Ackman started fairly, without a lot of money. The power of compounding, helps there. So say start as early as possible, and talk to people about it. And if you're really good, someone will give you some money. If you work in the industry, it's going to be a little bit easier, but there might be limitations on trading and things like that, which might, on the other hand, make it a little bit more challenging. But you can paper trade, stuff like that. Size, when should you start? If you're interested in it, you should start when you can't not stop doing it. I think, like if you just cannot handle anymore, not doing it, not having it, not starting, at some point, you can't live without it. You can't live without doing it. And because your passion is so great and your conviction level is so high, that you can't imagine not having the fun. You probably should start at that point.
Yeah, that makes a lot of sense.
Something I think Munger's kind of said this at times, or variations of this idea that, you basically is like, don't do it. Don't ever do it. You should never start a fund. You should never take over a public company. You should never do this, 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 and this. And the person who says, I hear you, and I'm going to do it anyway, that's the person who should do it. The person that says against all odds or against every piece of advice, I'm going to do it anyway. Well, that person's going to have a high chance of success.
Yeah, absolutely. I think that makes a lot of sense. And can you speak a little bit more about how you analyze management?
How I analyze what?
Management. Yeah,
I mean, there's a little je ne sais quoi associated with it. And really, investing is much more art than not. If you actually think about it, it took me a while to learn that. And analyzing kind of management and understanding relative to human nature. And there's a philosophical element to it too, which I think is pretty interesting. And there's incentives, what incentives are in place to have management act in a way that is in the best interest of shareholders. That's important. And how do you learn about incentives, right? Well, you go through the employment agreements. You look at the investors involved. You look at the decision makers at the board level. Look at the historical elements of the company itself. What is their culture? How do you figure out their culture? Well, you're not going to know completely externally, but you can kind of start to piece it together when you see kind of their capital allocation decisions over time. So, that's why it's valuable, I think, to read those employment agreements and to try to find out as much as possible about their historical decisions for the individuals involved at the board level and at the management level, going back 10, 15 years further sometimes. The other side of it is a great business will kind of cover up a crappy management team. And it might make you think they're great. And they might not be. But that's okay too, because, it's a great business throwing off, a lot. Like I would say, like a Google, for example, seems like they've got a great management team. I don't know. Seems like it. But the business is so great, throws off so much free cash that the management team doesn't even need to be that great to be a great business. But on the other hand, you look at like Amazon, right? It's a low margin business at the beginning. In certain areas today, it's not. But it took a great management team to be great. And maybe you learn about it from the things that they say or the things that they write, or you meet them and they seemed ethical. I don't know. You went to go meet them in person, and I don't know, they had a small office. They were kind of a man of the people or something with their other employees. Maybe you might think this is someone who knows what they're doing, but you can kind of easily be fooled. And so I think it's just very difficult, honestly, to make that assessment until after the fact. I mean, you could point today to maybe like 10 managers, obviously like a Bezos and like that would be a part of it, Buffett. Some other people, Mark Leonard at Constellation Software, for example. But I don't know, it's tough. And I think it's much easier to do after the fact. I think to try to get hints at it during the time that they're in charge, you really want to look at those incentives and kind of their historical decision making. And quite frankly, the activists involved, if there are activists, if it's an arbitrage opportunity or special situation or something, and the board members who are there and their experience and how involved they actually are.
Yeah, absolutely. I think that makes a lot of sense. And thank you for sharing that framework with us. Maybe speak about in the past, specifically about some of the arbitrage investments that you've made, and maybe examples of some that have been successful and examples of some that have been failures.
Yeah, I had this great arbitrage thing, this company called Iron Mountain. which was still is a storage facility primarily for documents for in the legal world. And they were converting to become a REIT, real estate investment trust. And let's say this is 6-7 years ago, 8 years ago maybe. And they were the first REIT application that was really not specifically real estate. It wasn't for the land itself. And so they submitted this to the IRS, and the IRS kind of put it on hold. And they wanted to examine it further. I think it took about a year for them to really give the approval, but at times it was unclear whether they were going to get this approval. But Iron Mountain was so confident they were going to get the approval, and when they convert to a REIT, you have to pay a special dividend out, because a REIT requires, you to pay a certain percentage of your net income or free cash flow or whatever out to the public, right, to the shareholders. And Iron Mountain was so confident that the application was going to be accepted that when they finished up their year, they paid out that special dividend, right? So you say, well, okay, be humble to what management knows, right? You're going to defer to them, because that was a major decision. If they would have paid out that special dividend and the REIT wasn't accepted, that would have been a major problem. But the arbitrage opportunity was in the options, because when you pay out a special dividend, it creates a second set of options. And so two options are kind of existing at the same time. One that recognizes an adjustment for that special dividend, and one that doesn't, ones that created after the fact. And so the volume and liquidity of that options that have adjustments are screwed up, because it's not like a Black-Scholes thing. Typically for options, you're getting this efficiency, from these models, but wasn't really taken into account here, because you had a strike price adjustment because of the special dividend. And even after the REIT was accepted, I think there was a mispricing there until the options expired. So that was an arbitrage opportunity on the options themselves. That was a great investment. There have been ones where again, net operating loss carry forwards and ALJ, for example, back in 2013-14, they did a tender offer for half of the shares outstanding at a price below its net cash. And they had a massive pile of net operating loss carry forwards when those were valuable. So that was a nice one. One that didn't work out, this company called Real Industry, same thing, this was in 2015-16. They had a big pile of net operating loss carry forwards. They had Sam Zell involved, the real estate tycoon. And they basically had a small business and these big kind of off balance sheet assets. And they ended up buying a aluminum recycler, and they took on a lot of debt to do that. And I owned the shares before that acquisition. And quite frankly, when the acquisition happened, I should have just sold, but I didn't. And that aluminum recycler was a terrible business to buy when you have net operating loss carry forwards, because it might throw off free cash, but it doesn't create a whole lot of net income, and for various reasons. And so they weren't really able to use that the NOLs. Not only that, though, the business turned out to be very difficult, because at that time there was like a flooding of the market from aluminum from China. The price of aluminum dropped. The recycling, additional expenses at the plants, it didn't really pan out anyway as a company. I think eventually it went bankrupt. Thankfully, I got out before then, but it was a terrible investment for me. And again, that was kind of an arbitrage-y type thing. I was kind of banking on the use of these NOLs, and it was more of a special situation type of investment. And then this acquisition, I was looking for an acquisition and things of that nature. So, you win some, you lose some, though. And investing is not a 100% game. It's a little bit more like baseball, where, if you make it out 2/3 of the time, you're a great player. And investing, it's more of, hey, that happens. You might want a higher batting average than that, but you better have a high slugging percentage. What that means is you concentrate into your best ideas. And even if you have a lower batting average, if you have a high slugging percentage, you're going to have a great return. I think that's what everyone has a little bit of a different style. For me, though, I think the reason why we've been able to have these great returns is because when I've made large investments, really concentrated investments, they've worked out almost every time, other than once or twice. I've made a 20% position, for example. And I'm in the process of kind of looking back at our historical investments and returns as part of our 10-year mark. And I think we've still kind of looking through, but I think 4 out of 6 of the 20% positions have been multi-baggers. And so that really does a lot for your returns. Yeah, I don't know, the arbitrage stuff comes, there's a huge, it's hard to say, well, this specifically is an arbitrage. I mean, sometimes you'll have some share class things. Sometimes you'll have some options versus warrants that you can buy and sell and, go long, go short, and things like that. There's a whole range of whatever the definition of arbitrage is. I think it's more of a mindset that you really want to arbitrage perception from reality. And a lot of times that perception is based on whether faulty information, a different time period outlook, or some other forced pressure for forced sales. And the reality of the business, the value of the business, if it's higher, then you have an opportunity there.
Yeah, absolutely. And for a concluding question, what are the most influential events of your investing career?
Say events?
Yeah.
That's a good question. I think probably reading some of those books to start. I think reading the American Capitalist, reading the Seth Klarman book, things like that, being exposed to that information was very influential to, my philosophy. A couple investments early on, I think that that informed kind of future investing and really hammered home that kind of strategy, I guess, my arbitrage philosophy, it's kind of the ALJ, I think. This is, there's a couple, I've been investing for some time, but it was really the first time I'd ever seen a company that was buying back, tendering so many shares at below its net asset value, also when they had off-balance sheet assets. And I remember thinking, who in their right mind who owns shares would sell them to the company at a 15% discount to its net cash? This is insane. And so I bought up as many shares as I could. And I was like, there's no way that this tender offer is going to be fully subscribed. And it was. So, I always knew people were irrational. I guess their rationalism is different than my rationalism, but I'd never seen anything like that. And yeah, it really kind of caused me to double down on my own confidence about the irrationality of the market at times, not all the time, but at times. And so that was a really important event for me. And then, also it was like a tremendous return, for a year or two also there. So that helped.
Absolutely. Thank you so much. This is a really tremendous session, and I really appreciate you taking the time out for your busy schedule to speak with us today.
Yeah, absolutely. Appreciate it.
Great. Thanks. Have a great day.
Thanks.